the year. How much of a problem is that if those big name tech stocks continue to struggle?
Yeah. I don't know that that's a problem at all, Scott. I mean, quite frankly, I think it's actually healthy for the markets that it's not just the 4 or 5 names that we bring up all the time and it seems like have been the leadership for so long. I think it's great that we're seeing some form of rotation that's actually sticking. I mean, just take a look at, for instance, the financials. How well they've been trading. You go all the way back to November, but year to date, they're doing extremely well. You look at the material space. You also look over at some of the other names in the energy space, particularly those beta names in the energy space, but even the big names. And I think it's very, very healthy that we're seeing a market that's not so dependent. It doesn't mean that we don't want these names to participate. I think we do. Many of us own a lot of these various stocks. But I think the reality is it's great to see the markets don't have to depend on those 4, 5, 6 names that we bring up all the time. And there is much more diversity out there. Even the consumer discretionary, you look at a lot of different areas in the marketplace that we have seen that performance that's being made up. And let's not deny the fact that just a few days ago, again, we were setting record highs, right? So it does say a lot about what's going on, I think, underneath. And it's not just a FAANG trade anymore.
Let me ask you this, though, Pete. What happens if the other areas of the market that you just cited are overextended, and these aren't performing at the same time? Isn't that a problem?
That would be a problem. I don't know that I would say that the financials by any measure are necessarily overextended. I think there's a lot in the energy space that's not overextended, especially when you consider the fact of where was crude? Crude was $38 back in November, and now here we are we were 63 just a couple days ago. We're still somewhere above 60. So, you know, I think there is support out there, Scott, for a lot of what these moves have been in a lot of these different areas, different sectors. And, you know, we talk about the semiconductors all the time. Many of those names still trade at a very fair value, but there are many that are obviously that probably are extended. So I think there's within some of these sectors, we have individual names that certainly reflect what you're talking about, which is, hey, some of these are extended. They're overpriced. I specifically would say that the high multiple names that had such a great run have certainly been an area that always makes me scratch my head and makes me a little bit scared because of the fact that they've run with absolutely nothing that can really truly support it other than the potential into the future. But outside of that, I think that there's a lot of different areas in the marketplace right now that still feel very comfortable for me to buy.
Let's be real, though, Jenny. I mean, it certainly makes it harder for the NASDAQ to do well if Apple and Amazon and Netflix can't pull their own weight. I mean, these were the ones that were driving the train. Now they're, you know, at risk of being the caboose. Don't go anywhere, camera. I'm here. There we go. We're back. Jenny.
And I think how wonderful is that? And I've been arguing for a long time that we don't need them to continue to be the driver of the train. It's okay if they take a turn being the caboose. And I think the way Pete phrased it is really well. We're broadening the base, and that's creating a healthier market. I was writing when he was speaking that diversity of leadership builds a stronger, more resilient market. That's what's happening now. And when we talk about overvaluation, one of the things Amy and I were talking about before the call is how many pockets and little areas in the market there are that aren't overvalued. You can look at many of the banks, and Pete was mentioning this too, and they're still trading at 10 times earnings, 12 times earnings, 8 times earnings. There's plenty of energy stocks out there that are trading at a fraction of the market multiple. So as those grow from 10 times earnings to 12 times to 13 times, you're just building a stronger market that's good for everybody. It's okay if FAANG takes a break and is the caboose. They have done their work over the past 5 years. Give them a break. Let them take a breather. Let them grow into those multiples. That's healthy and good for everybody.